Hi, this is the video on source documents and books of prime entry or first entry. Now, this will help with other bits of accounting such as errors, when we look at errors and how to deal with them, control accounts, and so you have to have a full understanding to be able to understand some other aspects of accounting. So I'm going to quickly go through how the whole system pretty much works. We have a transaction, so we do something, the business does something, and the transactions that we're going to talk about are cash sales, credit sales, sales return, cash purchase, credit purchase, purchase return. We might purchase an asset on credit, and we might make small cash transactions. Okay, so that's the transaction, and the source document that links to it, that the document that's created when we have those or do those transactions, we're going to go through. Then the book of first entry, into which those documents get first recorded, and then lastly the ledgers that they get, that information gets put into. Okay, so let's take a cash sale. Cash sale basically means the business sells goods, and a cash sale implies that payment is made immediately. So the business receives a payment for the sale we've made. Now, the document that goes along with that is a sales receipt. The business gives the customer a sales receipt. It's a receipt, but we call it a sales receipt. And any time where there's payment received, whether it's money straight into our bank account or as physical cash, that's going to always be recorded in a cash book. Whenever cash is paid or received, whether it's in the bank or as physical cash, the recording happens in the cash book. The book of first entry will always then be a cash book. If it's not, there's no cash in the transaction, then it won't be the cash book. A credit sale is when we make a sale, similarly to when we make a cash sale, but credit implies the payment is not made at that time. So we make a sale and we have someone who now will owe us money, but we don't have the cash today. That's what a credit sale is. Make a sale, some customer takes the goods and will owe us some money for now and pay hopefully later. The document that we give out that relates to a credit sale is a sales invoice. And a sales invoice is recorded in a sales daybook, or sometimes known as sales journal, so I've put that into abbreviations. Now, if we have a sale that we've made and the customer returns those goods, then that's called a sales return. And the document that we then give to the customer who's returning goods is obviously, it's related to a sale, so we call it a sales, but with this time it's a credit note and not an invoice. So we give the customer a credit note to denote the fact that they're returning goods. An invoice essentially means that the customer owes us more. A credit note implies or has the effect of reducing what's owed to us. Okay, so that means that they owe us less. A sales credit note is recorded in a sales returns daybook or sales returns journal. Okay, so that's a sales return. Recorded in the book of first entry is a sales returns daybook. So a cash purchase is where we've bought stock and paid immediately. Now, it could be that we've paid in cash or we've done a bank transfer to whoever we bought the stock from. So the word purchase implies that we're buying stock. In terms of sale, means that obviously we're selling our stock or inventory, or we made a sale to a customer. In this case, we've bought stock or inventory. So the payment has been made immediately, whether that's cash or transfer to the bank. What we get for that purchase, what the vendor then gives us, is a receipt, but we call it a purchase receipt. And anytime, remember we said anytime cash is paid or received, any payment, whether it's cash or a transfer from or to the bank, the book of first entry in that case is always going to go in the cash book. We have obviously talked about a cash purchase, but we could have a credit purchase where we go and buy stock, but we don't make a payment immediately. And then that means that we owe money to our supplier. So a credit purchase is making the purchase of inventory, but not paying at that time. So we have a debt that we owe, and we may hopefully pay that later. With the document that we get given for when we make a credit purchase is that we get billed, we get given an invoice, and we call that a purchase invoice. Purchase invoices get recorded in a purchase daybook, or otherwise known as purchase journal. When we get those purchases and we may want to return some of that stock that we bought, we do a purchase return. That's the transaction that we do. Maybe a few days later we decide we don't like some of the stock or inventory, we go and return it. The document that we're given for the return is a purchase credit note. So the supplier gave us a purchase invoice, a bill, a few days ago when we bought the stock, the inventory, and now when we go and return some of the inventory, we get given a purchase credit note for the value of what we're returning. Purchase credit notes get recorded in a purchase returns daybook or purchase returns journal. Other transactions, if you buy or sell something other than inventory, would be then recorded. So this is where we're talking about a purchase or sale of assets on credit. Remember, if we're doing a purchase or sale of assets for cash, where the payment is made immediately, that would always be recorded in a cash book. So in this case, when we're buying or selling assets, which is not inventory, assets are things that we want to hold on to and use within our own business, like machinery or vehicles, then that is not recorded in a sales daybook or a purchase daybook. It's recorded in the journal. And if we are buying or selling anything on credit where the payment is not made immediately, we are obviously going to use invoices. And lastly, when you have small cash transactions, when we're selling something for cash or we're buying something for cash, then we usually are given a receipt, or we give out a receipt, whether it's a sales receipt or a purchase receipt. And that then is recorded in the petty cash book, where we would use the imprest system to keep a cash float at the correct amount. So that's the transaction. These are the source documents that go along with it. These are the books of first or prime entry where those source documents get recorded, and then at the end of the day, they're going to end up in the ledgers. Now there's three ledgers. The main ledger is the nominal or general ledger. This is where we have the double entry, where we do all our double entry, where the T accounts are, including we have a T account for all of our trade receivables, all of our credit customers. So we have an account for all of them put together in one T account, in one ledger account. And that's called the sales ledger control account, or the trade receivables control account. And we also have one account for all our credit suppliers, our trade payables. So this one account is for total trade payables, all of them. And this is known as the purchase ledger control account or the trade payables control account. So that's the same thing. Now this account will have the balance on it will represent the amount that's owed to us from all of our credit customers, and the balance carried down on that at the end of the year will represent the amount that we owe to all of our trade payables, all of our credit suppliers. Now then, so all of these transactions will have some impact on the T accounts inside the nominal or general ledger, where we will do our double entry. And some of these transactions, such as when we make sales on credit, will obviously affect the trade receivables account. But then we also have a sales ledger, which is sometimes known as receivables ledger, which is a memorandum ledger, where we have individual accounts for each trade receivable or each credit customer. And we have individual accounts because this account over here only summarizes all of them, and sometimes we need to know how much individual trade receivables owe to our business. If we're going to give them a call to chase a payment, we need to know how much the individual trade receivable owes us, and that individual account is kept inside the sales ledger, or otherwise known as the receivables ledger. And the total trade receivables account, the balance owed to us on that should match the total of the individual accounts owing to us as well. We also have a purchase ledger, otherwise known as a payables ledger. This is also a memorandum ledger where we have individual accounts for each trade payable. So everybody who's a credit supplier to us, who we owe money to, they will have an individual account, T account or ledger account, inside the purchase ledger, inside the payables ledger. So they'll have an individual amount, and we can see how much we owe to each one on the individual account inside the purchase ledger or payables ledger. But the total of those should match the total that we owe to our trade payables that we are keeping account of in the purchase ledger control account or trade payables control account inside the nominal ledger as well. So this should match that. Now this is one way. If the two don't match, then we can check for errors. and then maybe we've made a mistake or missed something off. So it's a good way to verify correctness of our accounting system. So we do the double entry in here. So if we make a credit sale, for example, we would credit the sales account inside the nominal ledger and debit the trade receivables account inside the nominal ledger. And since the trade receivables is affected in this transaction, we would also update the individual trade receivables account inside the sales ledger or receivables ledger, which is essentially a place to store T accounts for individual trade receivables. And if we make a credit purchase or a purchase return, it will obviously affect the amount that we owe, and therefore it will affect not only the total trade payables account inside the nominal ledger, but also the individual trade payables account, individual credit suppliers account inside the purchase ledger. Hopefully this all makes sense now, and how we have transactions, we have source documents for those transactions, we have books of first entry into where those source documents go, and finally that information ends up in the ledgers, and sometimes we'll update the sales ledger as well if it has something to do with affecting a trade receivable. And some of those transactions may affect the purchase ledger when we have items that affect how much we owe to trade payables. One final note is that transactions that are in the cash book, if they are payments into or out of the bank, obviously if an amount of money has gone in or out of the bank, another source document you could use to check for that would be a bank statement. So anything that affects the bank within the cash book should also be visible on the bank statement. So that's another source document. Whenever something affects the bank, debit or credit, inside the cash book that will appear in or come out of your bank, you can also see evidence of that in a bank statement. And if you still use checks or pay by a check, then that will have a counterfoil or a check stub where you will write a copy of the data or information you've put on that check as evidence and a record for yourself. So you can also use the check stub or check counterfoil as a source document as well as what you see on the board.